And we are now joined by the Finance Minister himself, Bill Morneau. Minister, good to be able to catch up with you. Thank you very much for your time.
Thanks for having me on your show, Catherine.
Let me get your take in terms of the message that you really want to give to Canadians with respect to don't worry about the growing deficits. How do you justify that and additional spending at this time in the economic cycle?
Well, I think that's not the core message. The core message is that our economy is strong and it's growing. We've seen growth this year. We're expecting growth next year. We had 14 private sector economists who help us with our forecast, and all 14 are projecting growth. You know, we have strong employment. We've got this year we will have the lowest unemployment rates we've seen in 40 years, and wage growth is in excess of inflation. So that's all for the positive. With respect to the approach around the deficit, we're showing that the deficit is reducing over time, and that what you can see in this year's projection is both that we've put in place the middle class tax cut that we promised in the campaign, and because interest rates have gone down, pension liabilities have gone up. So that does have a factor in the presentation. But it's one that I think many of your financial analysts will look through to understand that it's really very much about investing in putting more money in people's pockets.
Okay, so a couple of points to pick up on. With respect to the middle class tax cut, did you not increase the marginal tax rate for those who earn $150,000 to $225,000?
What we did was we moved up the basic personal amount. So effectively, that means that everybody up until the very top tax bracket will have a reduction in their taxes. That amount will obviously depend based on how much people earn, but for an average earner, a single person, it's going to be about $300 when fully phased in annually in 2023. And for a single parent or for a two-couple parent in middle income, about $600. I mean, the bigger picture is it's putting about $3 billion into the economy next year, and then in the final year, $6 billion, and that's obviously going to people's pockets, but we expect that will have an economic impact as well.
Which I think we can appreciate, but at the same time, too, to get there, I was speaking with Jack Mintz, and he did the back of the envelope math and basically said that the marginal tax rate for those earning $150,000 to $225,000, so a lot of small businesses, entrepreneurs, is increasing by 1.5%. That is accurate, correct?
Well, you'd have to show me the numbers. I mean, I'm quite clear that those people in that category, their actual amount of taxes they pay will go down. I think what Jack is doing it from the BPA going up. So I think people care most about whether they're actually paying more or less taxes, and they will be paying less taxes in that category. You know, our goal is to make sure that a large number of Canadians, and in this case it'll be 20 million Canadians, pay lower taxes. We're not trying to have fun with numbers. We're just trying to make sure that people are better off. Mm-hmm. We're trying to deal with economic anxiety, and this is the first and most important measure we're moving forward with, because we see it as not only a campaign commitment, but the right thing to do for our economy when we're trying to keep the growth that we've seen to continue.
Minister, it's interesting. We talk about this all the time on BNN Bloomberg, get so many different people's opinions as it relates to what the economic outlook will be, not only just for Canada, but obviously from a macro perspective, because we are impacted so greatly by the United States as well as China. To your point, many economists do not see a recession in 2020. However, what is interesting is that our banking regulator, for the third time, has increased the requirement for Canada's biggest banks from a buffer perspective, a capital buffer. What do you think they're thinking versus what we're all talking about?
Well, first, I think that it's important to know that that increase in the bank buffer is not going to impact any of our banks, because they already exceed those capital requirements. So that's important to know. So there won't be any economic change from that standpoint. That said, I think it's always important to be prudent. I mean, as I think about the Canadian economy, we've very clearly said that we need to reduce the amount of our debt as a function of our economy. We need to maintain our AAA credit rating, and we need to be prepared in case of any economic downturn. That's just the right way to manage our economy. So that's us being prudent. You'll also see in our economic and fiscal update that we've committed to managing expenditures in a way that will reduce our expenditures each and every year. So while we don't expect a downturn, while all 14 economists that were part of our forecast, including chief economists from all the 6 banks, are all predicting a growing economy, we're still being careful and making sure that we have the ability to respond in case of any challenge.
And Minister, what levers would you have if in fact we did enter into a recession, in the sense that we all know that the monetary policy around the world for 10 years has been working really, really hard. If we're going down the deficit path, spending path, what other levers would you be thinking about that you would have in your power to help the Canadian economy?
I think we always need to be prepared. What people around the world are looking at when they think about the different situation we're in now versus, say, back at previous times when we've faced any challenge is, of course, that interest rates are lower. So that means that in any mix of policies, fiscal measures are more likely to be the ones you think about. But again, I think what's important to remember here is that we are in a position where we are investing, but we are expecting growth. We have a situation where our deficit as a function of our economy is lower than everyone else in the G7, significantly lower, I might add, except for Germany. Our debt as a function of our economy is much, much lower than all other G7 countries. So we have the capacity, we're in a good fiscal situation, and of course with the low current interest rates, investing at this pace is a sensible thing to do and consistent with what people around the world at the IMF or the World Bank or the OECD are suggesting at this particular economic time.
It's interesting, though, that the low interest rate environment is also what caused the need to increase the pension obligations, and that was a factor in terms of the increased deficit. Are your expectations that we will continue to see this? This will be something that we will repeat?
Well, it's not really a need to change something. It's just more an economic reality. When interest rates go down, liabilities go up.
Right.
So it's more of an accounting presentation. So what we've outlined in our current update is that we're going to ask experts to take a look at how we present our financial statements to see if it's helpful to add a line so people can see what the actual operating balance is. That we think might be helpful. People in the private sector will feel that to be quite consistent with what they've typically seen. Certainly other countries like New Zealand and Australia have already gone that route. But we haven't made that decision yet. We'll listen to experts, and we want to keep on our approach of being very transparent in our financials, helping people to understand what we're doing, and I think that's broadly helpful.
Minister, there's been so much discussion about the lack of domestic business investment spending over the past 4 to 5 years, maybe even over the past decade. When we take a look, when you and I are talking about the growth expectations for Canada, call it maybe 1.7%. U.S. looks to be growing at 2.4%. Are there other aspects that you could be doing that would encourage more business investment spending? And of course, we can talk about in Canada moving their headquarters south of the border. We can talk a lot about the energy services providers that are also looking more to the United States where pricing margins are better. What more can you and your colleagues be doing to encourage better growth versus what we're experiencing and to play a bit of catch up to what the United States is seeing?
I think, well, first of all, we just need to make sure we're dealing with the same set of facts. So foreign direct investment is increasing, so we are seeing an increase right now. Of course, what you're talking about mainly is the resource sector, which I'll acknowledge is under some severe strain, and the challenges there are very real. It's one of the reasons we're trying to work together with people in Alberta and Saskatchewan to see about things that we can do together. I think from our standpoint, the accelerated capital cost depreciation we put in a while back is important. I think we're starting to see that come through the economy now. And while you do compare us against the United States, which of course has a deficit that is more than 5 times ours is on a per capita basis, so a very significant amount of deficit spending, compared to the other G7 countries, we're actually ahead. So look, we need to continue to think about how we can improve investment. I'm encouraged to see that our economy remains strong and that unemployment and wage growth is in the direction that we want. That is unemployment lower and wage growth higher. So we'll continue to look at how we can invest to make this the continuing case, and we'll listen to ideas from Alberta and Saskatchewan that might be helpful in the resource sector as well.
Many entrepreneurs would say that if we can decrease the interprovincial trade barriers, that would be a big help. If you can decrease some of the red tape, that would be a big help. And of course, there's the carbon tax. These seem like made in Canada solutions.
I think absolutely. Anything we can do to reduce interprovincial barriers is critically important. Those are overwhelmingly provincial barriers that we need to work to break down. We need to think about, as you said, how we can reduce regulatory impacts, and that's something we are working on, and I'm certainly engaged in that process. With respect to putting a price on carbon, we think this is the most economically efficient way for us to deal with reducing carbon emissions, and that is something that we're going to continue to focus on. It's obviously something that economists have said is the most efficient approach, and as we move forward, we'll be thinking about other ways that we can reduce our carbon emissions so that we can deal with our climate change challenges. We need to do that while also thinking about the immediate challenges in Alberta and Saskatchewan with getting a fair price for our resources, which of course we're doing as we move forward on the Trans Mountain expansion. So we're doing more than one thing at the same time. That's what we need to do and what Canadians expect us to do. And the good news is it's working to see us have a growing economy.
Speaking of the Trans Mountain, what's the latest that you can tell us as it relates to pipeline progress?
Well, there's work going on. There's about 2,200 workers actively engaged in that project. There's work at the Burnaby, the Westridge, and the Edmonton terminals. We're seeing progress. Obviously, our goal is to move forward as fast as possible, and I'm just happy that the work is actually happening in the way that we had hoped for.
And then what? What's the next step?
Well, the way it works is they need to keep working and putting the pipe in the ground. So that will be the next step, obviously, as they finish these terminals. And, there'll be more information coming from the company, I'm sure, probably in January on their progress.
Minister, I have to ask you as well, because the housing market, real estate in Canada is such a hot topic for so many people, including many of our viewers on BNN Bloomberg. Something that stood out to a few people in your mandate, you say that you will review and consider recommendations from financial agencies related to making the borrower stress test more dynamic. What does that mean, and are you specifically referring to insured or uninsured mortgages?
Well, let me start with the fact that the space that OSFI is responsible for is the uninsured part of the market. The space that I'm responsible for is the insured part of the market. So that mandate letter was referring to the insured part of the market. What we've said is that we are going to constantly listen to the agencies responsible looking at housing. It's important to make sure that we consider expert opinion. From my standpoint, this is one of the most important financial stability issues. Housing is our biggest asset class. It's critically important that we keep the market stable. So we will be listening and considering, as my mandate letter said, thinking first and foremost about financial stability and also about protecting the market so that we don't have any unexpected rises. The worst thing for affordability in the housing market is if prices go up and get out of reach. So we're going to be careful on this, but always considering whether we should make changes as appropriate.
Do you think any changes need to be made right now with what you're seeing in the housing market?
Well, what we are seeing in the housing market is a slight pickup, as you've seen in Toronto, for example. So that's important to consider. But what we really do also look at is just the level of indebtedness across the country. I think people need to look at that as well. We see high levels of household indebtedness across the country, not necessarily related to the high pockets of housing challenges. So even in Alberta, we have a high level of household indebtedness. So we need to consider these factors together. I don't have any news in that regard. I will be, as the mandate letter said, I will be listening to, reviewing, and considering new information as it comes out, and be careful, but move forward if there's a situation that allows us to do so.
And Minister, just last question, I've got to get your take in terms of all the trade tensions we've seen around the world and the impact that that can have, of course, on our economy. What is your latest view, almost putting pen to paper, as it relates to new NAFTA and the easing trade tensions between the United States and China, and what that might mean for our economy?
Well, it can only be good that we have positive direction on trade issues. We were very enthused last week with the new NAFTA. I think that's moving along well, both in the United States and in Mexico. I was literally speaking to the Mexican ambassador in the last half an hour about that. So that's positive. The U.S.-China situation sounds positive. I'll be in Washington Wednesday talking with my counterpart, Stephen Mnuchin, and have more understanding of that. But we can only look at that as a positive direction. So, we had baked into our reality probably less investment as a result of trade tensions. So anything that relieves those can only be positive. So I'm very pleased to see that.
Okay, we will leave it there. Thank you very much for your time.